Ladies and gentlemen, welcome to the July Coronation Interactive Session. The topic for today's discussion is capital mobilization through the private markets. Delivering the keynote address for today's session is none other than Mr. Bola Onadele Koko, Chief Executive Officer of FMDQ Group. There will also be a panel discussion with leading economists and financial professionals. Joining in the panel discussion is Magnus Noka, National President of Risk Managers Association of Nigeria and Chief Risk Officer of Coronation Merchant Bank. Along with Magnus is Chinwe Egwim, Chief Economist, Coronation Merchant Bank. And lastly, Suru Daniels, Head of Investment Banking at Coronation Merchant Bank. Our moderator and host for today's session is an award-winning journalist, conversation strategist, and curator. Please join me as we welcome our host and moderator for the day, Mr. Wale Famurewa.
You are welcome to the Coronation Merchant Bank Investment Forum. My name is Wale Famurewa, as mentioned in the intro, and I'm delighted to be moderating today's session. Now, this session is designed as an interactive session for issuers and institutional investors. And the whole point of it is to explore options for you to raise capital in the private markets. Now, capital, many will say, is the lifeblood of businesses. So this is certainly a very germane topic, and we look forward to you participating in this interaction. And I'd like to say off the bat that this event is not about me, it's not about the speakers that you'll be hearing from, but indeed it's about you, the attendees. So we'd like to encourage you to make the most of the opportunity to learn, to listen, obviously, but of course to also share your thoughts. And just as I proceed, before we proceed with the program, I just want to just highlight a few housekeeping issues, and I will be speaking also to how you will get involved in interacting with us over the course of the event. So the first point is just to emphasize that this event is being recorded. And then, as I mentioned, if we would like to hear from you, we'd like you to not just listen, but to participate, to share your comments and questions. And as you do so, we'd like to encourage you, if you are joining us on the Microsoft Teams platform, look for the Q&A field on the platform and share your comments and questions. When you do so, please be sure to introduce yourself, your organization, and of course, if you are posing a question, who you are posing that question to. So let's get started, and I would like to now invite, without further ado, to help us set the tone for the event as he delivers his welcome address. Please welcome the Managing Director and CEO of Coronation Merchant Bank, Mr. Banjo Adegbongbe, as he delivers his welcome address.
Wale, thank you very much for the introduction. Good morning, distinguished ladies and gentlemen, investors, issuers, regulators, and members of the press. You are warmly welcome to the maiden edition of the Coronation Interaction Sessions. The Coronation Interactive Session Series is the initiative of Coronation Merchant Bank to stimulate discourse and to clarify and enhance pertinent economic and societal issues, with the primary intention to widen the ideation process and develop credible and workable solutions to common challenges. It is our intention to continue to facilitate productive engagements like this with relevant stakeholders in order to generate solutions for critical sectors of the economy and to add value to our existing and potential customers alike. We chose the theme for today's session, capital mobilization through the private markets, specifically because of the potentials we see in the private segment of the Nigerian capital market. This market has had its fair share of missteps in the past, but we have begun to observe very credible and increasingly sustainable structures being built to organize the otherwise arbitrary situation earlier observed in this sector of the market. From technology to renewable energy and various other sectors, it is now obvious that companies need not become publicly quoted to attract much needed capital. In fact, it is obvious that with clarity on entry, monitoring, and exit, investors can make more informed decisions on the investment opportunities that abound in credible private companies. Liquidity of instruments, pricing transparency, and governance are some of the issues that have been raised in the past. We expect that today's session will help address all of these and more. Permit me to close this by thanking our guest speaker, Mr. Bola Onadili, also known as Coco, ably represented by the Managing Director of FMDQ Private Markets, Mr. Yemi Oshinubi. I would like to thank you for honoring our invitation. I would also like to thank our panelists and every member of our distinguished audience. I wish you a productive and fruitful session. Thank you for your attention.
Thank you very much, Mr. Adebonwe, for that. Nicely setting the tone for what should be a very useful session. And one of the key takeaways from his short address was that he mentioned that the structures are already being built for us to improve the interaction between issuers and investors in Nigeria's private markets. And so it really is a good place to introduce our next speaker, who is our keynote address, who will be delivering our keynote address today. He's none other than Mr. Bola Onadili Coco, who unfortunately is unable to be with us. Bola Onadili Coco is the Managing Director and CEO of FMDQ Group, but he is certainly ably represented today by the head private capital at FMDQ Private Markets, Mr. Yemi Oshinubi. So I'd like you to please put your hands together for him as he steps to the lectern and delivers the keynote address.
I'm Yemi Oshinubi. I'm the head of private capital at FMDQ Private Markets Limited. We were set up in February 2020 to organize the private markets. The private markets have always existed in Nigeria in different nooks and crannies, and we thought it was a great idea if we wanted to have a better way for capital mobilization for different segments of companies in Nigeria to actually have a place, a marketplace where institutional investors, issuers, credible issuers, and sponsors can come together and operate a market where risk is properly defined and information, the problems of information asymmetry is taken care of. So in my first slide, I'll be talking about capital mobilization. And so the traditional channels, as you may know, include for companies small, all the way from small companies to large companies, will be bank lending and access to public capital markets. Non-traditional markets or channels would include, what globally may be referred to as alternative or alternative assets or alternative markets, but it's the terminology that sort of coalesced as of today would be private markets. And so the private markets will be the focus of this presentation. There's been a long shift towards private capital as banks and public markets have transitioned from serving small and medium-sized businesses to larger companies. These structural changes have come as a result of many things, but probably the most recent was the global liquidity crisis of 2008 and 2010. As a lot of people will know, the Basel II requirements for banks were tightened. The way risk assessment was done for credit has really been tightened, and that has affected how the markets have, how private companies have been able to access markets from the bank. So those traditional sources of capital have become less available because of regulatory burden on public companies. And so as we have seen, banks retrench a little bit from the middle markets, not to even talk of the small markets. And it kind of makes sense for banks to, as banks have gotten larger, they have more capital. They have to find ways to scale their lending. And so they focused on larger, higher rated borrowers. But also on the public markets, there's also been a shift to larger companies. The average market capitalization in the US markets has gone up from 1.7 billion in 1998 to 8.3 billion in 2019. Apple itself crossed the 1 trillion capitalization bar, I think 2 years ago, and many other, and I think one or two other companies have joined it in that $1 trillion capitalization. So public markets have shifted to larger companies, and the middle-sized companies have not been able to tap as much into that market. But as that has happened, we've also then seen the growth in private equity market. So private equity assets under management has gone up 4 times since 2002, and since 2015, the private equity deal volume has exceeded public equity deal in volume. At the same time, again, because of the shutdown or the slowdown in lending from the banks, we've also seen a growth in private debt, and a number of companies today are preferring to stay private for a lot longer. So you see these growth drivers that's happened in the markets. In the next slide, in my slide 4, we see other structural changes that have happened in the markets to sort of drive the growth of private markets. Investors are leaning into risk to find alpha, to find better returns for their investments. Institutional investors across the world are in search of alternative channels, outlets for their growing funds. Asset bases have really increased globally, and asset managers need to find diversification benefits. The public market itself has, like I said, offers limited options, especially in frontier and emerging markets, whereas private markets offer an opportunity to focus on a theme. There are a lot of institutional investors who want to invest in either infrastructure funds, folks who want to invest on ESG themes, folks who want to invest in sort of the social space. And so private markets are a way to sort of focus yourself or focus your funds on the themes that interest you as an asset manager. Point number 4 is also that raising capital in public markets also comes with high regulatory requirements, and the cost of compliance for public companies has risen, and it's quite high. As such, many companies prefer to remain private for as long as possible. The conveyor belt used to be you raise seed funding, you got venture capital funding, and then maybe some private equity, and then you went and listed, did an IPO in 5 to 6 years. A number of companies have crossed the 10-year mark without listing because they prefer to stay private for much longer. Also, the idea of private guidance versus over public scrutiny. Publicly traded companies, publicly listed companies, they require high levels of disclosure. A lot of companies prefer to raise private capital from institutional investors that maybe understand their business, their theme, their sector, and then they can provide or they can access guidance on that sector. So if you raise money from a private equity firm, for example, you may choose to invest or to take investment from a firm that knows your sector, is a specialist in healthcare sector, is a specialist in infrastructure, like I mentioned before, or oil and gas. And so the idea of having an opportunity to tap into private guidance in addition to capital is also very attractive to companies. And so you've seen the ascendancy of private markets over public markets in the last few years. And so speaking about just the overview, the industry structure for private markets, private credit has reached almost 0.8 trillion over the last 5 years. It's grown significantly since 2009, 2010, like I spoke about. But the big deal that we've seen has been private equity. Over the last 10 years, private equity has hit 4.5 trillion in assets under management. Those global funds are finding their way into Africa, but also Nigeria. So even though these are global figures, 7.3 trillion in assets under management across all different asset classes are finding their way to Africa and to Nigeria in particular. So the long-term growth of private markets is substantial. There are active firms closing in on about 11,000 in 2020, and the industry is experiencing about a 5% growth. And we think this is going to continue in the next 5 to 10 years. Again, next slide showing the different asset classes. Private equity, like I mentioned, is the asset class of the moment. Opportunities for acquisition. In the West, a number of public companies are getting bought out by private equity companies, again, to move into that private market space where they feel like they can grow a whole lot quicker and without maybe so much public scrutiny. And more recently, you've seen the growth in SPACs that are offsetting a shift from the public to private markets. So probably, but in spite of that, we still believe that private markets or private equity will continue to grow. The private credit market has been substantial, especially in Nigeria. In an FMDQ, which I'll speak to in a little while, the platform we've set up has seen almost 264 billion naira in noting since it was set up in 2020. And so private credit will continue to grow in Nigeria. The infrastructure natural resource sector, especially for in Nigeria where access to, I'm not talking about public capital markets, public funds for infrastructure, meaning funds from the government. We know the public purse is challenged, and the real opportunity for Nigeria and Africa as a whole is how to tap into private markets to develop the infrastructure space. And so we believe this infrastructure market, the infrastructure market will probably be the biggest driver of growth for private markets in the next 10 years in Africa and in Nigeria. For the real estate market, in spite of the effects of COVID-19 on retail space, Africa and Nigeria, we've never really had sufficient, where you call it housing or commercial space. So we still believe that market still continues to grow. Globally, it is growing, and we feel like we will see much of that in Nigeria also. Now, some of the challenges that you'd see in private markets: illiquidity, opacity, cost of capital. Unlike public capital markets counterparts, private market investors cannot easily value or sell their stakes, generally speaking. This illiquidity makes valuation of your investments a bit challenging, difficult for asset managers. And so private capital investments are typically better for investors who have a longer-term investment profile, a longer-term investment horizon. Again, due to the lack of, or due to lower regulatory disclosure requirements, access to financial and operational information necessary to make sound investments are not always present in private markets. And the third thing is that because of the aforementioned issues, that illiquidity challenge and information asymmetry often means that investors will demand a premium on the capital that is invested. And so the cost of raising capital in private market is typically higher than what you would find in the public markets. Private markets in Nigeria, again, pioneered by the developed financial institutions in Africa and then in Nigeria. You see some of the names like CDC, IFC, and Proparco. But just like private equity accounts for over 60% of assets under management globally, in Nigeria, it's also dominated, private equity also dominates the private market space. And some of the characteristics you will see of private equity investments in Nigeria: 80% of PE investments in Africa were below $50 million. So they're still fairly small compared to what you would see happening globally. And in the private equity space for Nigeria, the asset managers will typically take a minority stake in their companies due to the developing nature of the market. It's hard to take over all the majority stake in the business, because then you don't have as many incentivized founders. So you still have to take minority stake in order to make it work for you. And so private equity, even in Nigeria, has not scaled as much as you would find in the West. The other thing to consider would be the number of LPs. So actually, 100% of LPs surveyed recently would factor in environmental, social, and governance issues factors when they're considering what investment they want to make in an African private equity investment. There was an attractiveness survey with general partners that ranks Nigeria as second as the most attractive country for private equity investment over the next 3 years, with a focus on the healthcare, life sciences, and technology and agribusiness. And those are viewed as the most attractive sectors by general partners. From the LP perspective, the limited partner perspective, Nigeria ranks third in attractiveness of private equity investments in Africa. Healthcare, similar sector attractiveness, healthcare, life sciences, technology, but also financial services from the LP's perspective. These are viewed as the most attractive sectors over the next 3 years. And so when we then talk about how private equity or private markets has evolved in Nigeria, it's gone from unstructured private equity, when you think of all the different classes, unstructured private equity or unstructured private credit from family and friends and things like that, to venture capital funds, to fund managers, private credit funds, finance houses, fintech companies. But now we're seeing a movement to what I would call organized private market platforms. Organized private market platforms where you can serve both the equity and credit needs of businesses. And the idea is that rather than going to a venture capital fund one by one or to different private credit funds, you can have a platform where you can meet with all these different investor groups and do business with them. We've seen that happen in North America with NASDAQ Private Markets. We've seen that happen in Singapore with Funnel, and FMDQ Private Markets has been set up to serve the Nigerian markets in that manner as an organizer of private markets and as an information repository, and more on that a little bit later. And so the primary goal for establishing FMDQ Private Markets was to democratize capital markets by promoting the inclusion of private companies. We want to unleash the untapped capital pools of capital that are available in Nigeria. Some of the value proposition that we bring as a private markets platform is an enhanced distribution channel. You have access for an issuer, you have access to a larger investor base. We provide transparency and information symmetry. Again, I would say again, some of the challenges I mentioned a while ago. Why would investors in a company sometimes demand that maybe a company go and list? Why is it attractive for a company to go and list on an exchange? It's because of governance issues. It's because of information asymmetry. What FMDQ Private Markets has done is to provide a platform. It's not an exchange. We're not a regulator. We're just an organizer. It's a platform where it's an information repository where issuers of capital make commitments to provide information as at when due to their investors. So whether they're quarterly reports, keyman reports, credit reports, all kinds of things that will give investors confidence that the business that they've invested in is doing well. FMDQ Private Markets, as part of its guideline, would require issuers of capital to provide that information. So by organizing that market, by bringing in good guidelines, we're able to de-risk that market just a little bit for investors. And so transparency and information symmetry is probably the biggest advantage you have when you come and note on FMDQ Private Markets. There's less light touch regulation and less burdensome documentation requirements. We go to the heart of the matter. What do investors need to see in order to put money in a bond or to invest in the equity of a business? What do they want to see on an ongoing basis post-investment? That's what we provide in terms of guidelines for the different products on FMDQ Private Markets. We're able to use a mark-to-market model for the securities that are noted on the platform. While there's not a lot of active trading in private market securities, but trades do happen. And so as a platform, we're able to use the mark-to-market model to help investors perform valuation for their investments. Again, we provide issuers an opportunity to stay private longer. The MD talked about that. You don't have to go public in order to raise money, in order to de-risk your business. Opportunity to stay private longer, and the issuer has a ton of visibility. One of the biggest, I would say, selling point to a particular market class, venture capital, private equity. When I worked in private equity, we used to say that our exit thesis it could be weak in Nigeria compared to the rest of the world. And what I mean by exit thesis, I'm going to invest in this business. I'm going to improve its operations. I'm going to reduce its debt. And then in 5 years' time, I'm going to exit. How am I going to exit? I'm either going to sell it to a strategic investor, somebody else in the industry who likes this business, or the business is a better fit for it, or preferably for the management of the business, we go and do an IPO. That's been the traditional exit route for Western companies in the private equity industry. Well, in a market where you haven't seen, I think in the last 5-7 years in Nigeria, you had less than 5 initial public offerings. What are you going to do if you're a private equity business that has invested in all these instruments? Well, what the FMDQ Private Markets platform does for you is that when you come and note that security, you give visibility to the company that is there. And then that ecosystem of investors will see how the business is performing, how the securities are traded. And this is what has developed the market for secondaries in the Western markets. Secondaries are when a private equity firm buys or invests in a business that is being exited by another private equity firm. By providing issuer visibility, by providing all this information on a potential security, the exit of one PE firm from an investment becomes that much easier. Again, without having to do an initial public offering. Right in the private market, you can get exits for your businesses. And so, just I think the second to last slide, how do you then raise capital through these private markets? Well, we have an ecosystem. Our platform enables private companies to offer debt equity issuances strictly via private placement to a large pool of qualified institutional investors through our authorized transaction sponsors upon the satisfaction of the key criteria that I mentioned earlier in our noting guidelines. So a company appoints a transaction sponsor, raise capital from qualified institutional investors, and then notes it on FMDQ private markets. And then this sort of post-noting information provision for the investors are provided on that platform so that investors can track the performance of their businesses, of the securities they're invested in. And so the options for accessing private capital on FMDQ private markets include start from the very short-term instruments, promissory notes, to longer, medium to longer corporate bonds, sukuks, participatory debt notes, green bonds, and equity. And I was mentioning, just talking about numbers, in 2020, about 100 billion naira in private company bonds were noted on the platform. This half year alone, we have about 153 billion naira in notings. We've had a mix of promissory notes, corporate bonds, sukuks, and we are having the first green bond that will be noted in the coming month also. Our equity guidelines should be coming out fairly soon. We started, FMDQ, we're known for bonds. It's a market we know very, very well, and that's where we started from. But we've been in discussion with the venture capital community, the private equity community, in how to develop this equity market for them. We think it's going to be really, really robust market that would help small to medium businesses who are trying to raise capital. And so our equities guidelines will be out within a month, and we're going to proceed with the noting of equity securities. In terms of how we're then ensuring that both the middle market companies and small businesses are enjoying access to capital, in addition to the large companies that are, sort of better positioned, we have created both a cradle board and a growth board in addition to the main board that existed last year. And that allows companies across different market segments or company segments, whether they're just start up to 2-year-old, between 2 years and 5-year-old companies, and companies that are larger than 5 years and who have a large capital base. All of them are welcome. We provide sufficient guidelines that will enable them to note and hopefully have a successful noting period on our platform. Thank you very much. I will be available throughout the day. Well, it's my pleasure again, and I hope that Coronation has been a very, very close partner with us in developing both products and sort of putting structure around FMDQ private markets, and we hope we'll continue to be a partner with you in Nigeria. Thank you.
Thank you very much, Yemi. I mean, that was very rich. Obviously, an introduction to the world of FMDQ and the private markets. But beyond that, it really took us through some history as to why these markets have developed and how they can be effective. So really appreciate that presentation. And I want to believe that that presentation has armed you with a lot of information with which you will engage us, because now we want to transit to a panel conversation. And as I had mentioned earlier, this event is about you, the attendees, not me or any of the speakers. We want to make sure that it's as useful to you as possible. So I want to again encourage you to listen, but to also ask questions and share your comments. And indeed, I imagine that quite a few issuers and institutional investors joining us today will have some useful insight into their experience in this private market. So once again, I want to encourage you to use the platform. You find the Q&A field on the platform, and please share your thoughts, comments, and questions. And when you do so, please, again, I want to emphasize that you should introduce yourself, your organization, and of course, if you are posing a question, who you are posing that question to. So let's move on to the panel conversation. And I'd like to now quickly introduce our panelists. They are already seated, and I'll be inviting one more to join us. Starting with Suru Daniels, who is the head of investment banking at Coronation Merchant Bank. Thank you so much, Suru, for joining us today. Next to Suru, we have Chinwe Egwim, who is the chief economist at Coronation Merchant Bank. Chinwe, it's always a pleasure to chat with you, sharing some useful insight in terms of how the macro story really impacts what we're discussing today. And we also have Mr. Magnus Noka, who is the Chief Risk Officer at Coronation Merchant Bank. Magnus, thank you so much for your perspective and for joining us today. And last but certainly not least, you just heard him, and we'd like to invite him now to be part of the panel, Yemi Oshinubi from the FMDQ. All right, I think it will be useful to start with Chinwe, so she can give us a very useful macro feel to this conversation. So we're talking about capital mobilization through the private markets, and the markets are situated in the economy. So I'd like to get your thoughts on the economic environment right now as it relates to capital mobilization. I wanted to get your thoughts on how conducive you think the environment is for raising capital, and I imagine that you'll be speaking to things like the interest rate environment, foreign investor interest, and so forth. Over to you, Jim.
Thank you so much, Wally. So yeah, the macroeconomic environment remains hazy and is not as conducive as it should be to encourage effective capital mobilization. There are structural issues that I'm sure all of us are aware of, and relatively weak economic frameworks as well. Now, I could group them into buckets of fiscal and monetary, but I'll just touch briefly on the fiscal side. We could introduce a comprehensive tax policy framework. We could also look into fiscal responsibility across state governments. These are forward steps that would support capital mobilization. And must also note that exchange rate policies play a really key role with encouraging capital mobilization. Now, the reality is that there is a pool of savings in the private sector of the economy, and this can be further optimized to ensure that providers of capital are not just protected but also rewarded. Well, if you look at the capital importation data released by the Bureau of Statistics, and I'm referring to that of last year, you would see that there was a downward trend, significant downward trend for total capital imports. I believe in the first quarter of the year, it was as high as $4.3 billion. And then as we progressed, second quarter, we saw it drop to about $385 million. If I cross-check my data, $385 million. We saw it creep up a bit to slightly over 400 million, and then it ended the year at just 35, final quarter of the year. Now, this decline in total capital importation can be attributed to, of course, heightened risks triggered by the pandemic, one, concerns around the Naira, two, and thirdly, the difficulty for investors to repatriate their funds. So those three. And then if you look into foreign direct investments, we've seen a downward pressure even before the pandemic. And of course, the main culprit for that is more structural deficit. So challenges such as power, epileptic power supply, and stuff like that. Now, although foreign capital should be pursued, local capital should also be encouraged. That said, whether you're an investor that's foreign or local, there are three things that I know stand out. One is capital preservation, that's one. Two would be investors care for a premium over inflation. and of course stability, and that's where something like the exchange rate would come into place. I'll just stop there for now.
The interest rate environment, because I think over the last 18 months, we've seen a major shift there where rates were relatively low, and many will say that really stimulated a lot of capital raising from some local investors, especially those who would like to refinance and perhaps take the opportunity to take long-term capital to address some of maybe their working capital needs and so forth. But now that has shifted, do you think that makes the environment a lot more difficult for capital, for those who would like to raise capital now?
Yes, my answer is yes. And I also like to just point out that now that things have changed, you have the crowding out effect coming into play, and investors would just generally tilt towards a safer investment. So yeah, so my answer is yes.
All right, thank you so much for that.
My pleasure.
Okay, so let me go to Magnus now and hear your thoughts on risk. Beyond being the chief risk officer at Coronation Merchant Bank, I know you also head a trade group in the markets relating to risk. So your perspective would be very useful here. In terms of addressing capital in a capital base of an institution, I wanted to hear your thoughts about some of the risk factors that issuers should consider in choosing things like equity and debt. In the current environment right now, what are your thoughts on that?
Thanks, Wale. I think I'll start this way. There are two perspectives of the risk. The macro risk, and of course, what I also call the micro risk. The micro risk will speak to the unique position of the capital issuer. Because you don't just go to market for the sake of going to market. And the choice between debt and equity is also what is informed by a lot of variables. Because you have to consider the risk between having dilution of ownership and of course retaining ownership. And of course the age of the business also matters. At the earlier stage of a business, the preference will be equity more than debt. Because at that point in time, no matter how good the business is, there's always a teething problem, and there are always losses in that initial stage. So the choice of debt or capital will be informed by that. And of course, you also have to look at the specific risk metrics, because at the points when you enter into a particular sector matters. Globally, we saw 1990s when people entered into Internet of Things and all this, which was booming, and a lot of venture capitalists, a lot of funds flowed there. And when we saw the burst in 2000 and 2002, and also what happened in the real market, so it's important for you to identify the unique risk in the markets and the unique risk in that particular investment you want to do. And I also talk about, because I think when our keynote speaker Amy was talking about private placements, before and now, before this time, the risk is obviously very high. You talk of conflict of interest, you can't rule it out, but now we have discipline within that market. With FMDQ coming in now to create some regulatory environment, which will ensure that there's discipline, there's more disclosure, and of course, even valuation. Before this time, you have valuation risk. And of course, there's also cash flow risk. So in totality, the choice between capital from debt or capital from equity is something that you have to situate within the business itself. And of course, looking at the macro environment, as Chinwe was also talking about it, you have to look at the interest rate environment. You also have to look at the alternative options you have. And these are some of the risk factors you have to consider when taking an option, whether to go equity or to go debt.
What about foreign exchange risk? Because obviously we are trying to also lure foreign investors, and we have seen in the regulated markets, companies go for Eurobond issues, for example. So your perspective on bringing foreign capital into the mix here, in terms of the risk that businesses potentially will be taking as they try to lure investors in?
No, I think talking of the foreign exchange risk, frankly speaking, for any business that wants to also raise foreign debts or in terms of equity, also in foreign currency, you also must have to consider not only the projection of the exchange rate direction, you must also ask yourself your FX generating capability, because it's important. If you don't, and you don't also take a long-term view of the direction of exchange rate, you are going to run into a loss.
So you won't. So you will not recommend a business that doesn't generate foreign exchange directly to take up foreign denominated capital.
But I wouldn't be very, very strict on that, because if you have a significant margin that covers you for the exchange rate volatility, you can take that risk. But the ideal thing is that you must consider the ability to generate foreign exchange from your operations when you are talking of taking also a foreign exchange exposure.
Of course, right now, to even get the foreign exchange is quite challenging. All right. Okay, let me go to Suru now. Now, Suru, to a large extent, I would say you are sort of our chief host here, because your business, investment banking, is really the one that brings the skills and the advice to our audience today. So you obviously have seen it all in terms of how the markets have been evolving. So can you just speak to some of the trends that we're seeing? No doubt, I'll be coming to Yemi to talk more about how the markets have developed, but specifically the things that you think people should know right now in terms of how this private market is evolving and how they can get involved.
Thanks, Wale. Thank you, since you called me the chief host. Thanks. I want to start by saying that the private placement market in Nigeria has been a journey. It's always been there, and it will always be there. Now, what we have begun to see since initiatives like what the FMDQ private market and a few other regulatory interventions are bringing to bear is more organization in that space. When Yemi was speaking, he spoke about what transpired between 2008 and 2010. And interestingly, off the platform, Magnus and I were having a conversation around how different people came into the market at different times, just issuing anything. Nobody is regulating, nobody is doing quality controls, nobody is ensuring the accuracy of information being presented, nobody is validating business cases. Everybody was just out there putting things in investors' faces, and unfortunately, those things were sold to investors that were not even fully aware of what their rights were and what the implications of the information they have been provided with could be. So you then saw the regular, even some of them pure water manufacturing companies, which is not necessarily wrong. I mean, if you have the structure, you have the governance, you have all of those things, and you are disclosing every step of the way, nothing is wrong with that. Now, you are now selling that type of thing to my mom, who had just enough education to get by. She doesn't understand investments. So one of the things we've seen, I mean, as a trend, is that all of those inefficiencies, inconsistencies, and misleading posturings are now being corrected. So over at Coronation, one of the things we do is we have our internal hurdle rates before we even present you to the market. Because again, there is a filtration process, a screening process. One is you think you're good. The next is we think you are good. The next is the regulator agrees with both of us. And then ultimately the investor says, okay, but even that investor is now being said, look, before you say this guy is okay, we need to know that you are in the right place to say so. So there is the issue of the qualified institutional or individual investor, meaning that it's not enough for you to have the money to invest. It's not enough for you to think you know what you're investing in. it's important that somebody says to you, hold on, are you sure you've checked this well? Okay, if you have checked it well, this is what you need to have to prove to us that you know to be able to be part of this deal or this transaction. You know what that does? That makes everybody come from a place of information. They come from the place of knowledge. They also come from the place of accountability. Because as a sponsor, I know I'm accountable to the market platform owner.
Sure.
And also to the issuer, as well as to you. Because every transaction, I mean, this is the way we work in Coronation. Every transaction we bring to you as an investor, we are practically taking a risk on that issuer because our name is involved. So that automatically kind of heighten the expectation paradigm, for want of a better expression. Okay, so you want to talk about trend, you could point at, like Yemi said, 7.35 trillion. I think that if we have reliable database, Africa alone could account for almost 50% of that money, because there are inefficiencies in private savings that could be taken advantage of. If the market knows enough, bank deposits will not be as high as they are. Okay? Now, if the market knows enough, some of the monies sitting idle with asset managers, with insurance companies, with banks, with pension fund administrators, as far as discretions are concerned, will be looking for productive engagements that will lead to job creation, that will lead to not only safety of principal, but at least a promise of return. And I think that with what we are beginning to see in terms of trend, there is a lot of sanitization going on in that space.
To the point that you made about institutional investors like insurance companies and so forth,
Yes.
I imagine we have quite a few of them on the platform.
Mm-hmm.
Would you say that many of them, from what you know in terms
Mm-hmm.
of what the private markets
Mm-hmm.
are able to deliver in terms
Mm-hmm.
of returns vis-a-vis risk, that many of them may be missing out on potentially higher risk return opportunities because they are not perhaps aware of the emergence of these private markets?
Interesting question, Wale. Very interesting, because, and I want to give a disclaimer right now. I respect asset managers because they do what I don't know how to do enough. I respect them because they're professionals in their rights. And I respect them because the primary job of an asset manager is to look for alpha. I mean, that unusual return that differentiates him in terms of portfolio management capacity. But, and this is part of why we're having the Coronation conversations, right? What you don't know eludes you. Okay? We think that the level of participation that we are seeing over the last 2 years is not representative of what the capacity of insurance companies, pension companies, asset management companies, and other asset managers, and all of those people in the asset management industry, fund management industry, are capable of. And I say that carefully and without meaning any harm, because what has been observed is that whether there are rules or there are no rules, just because it is not listed on a public exchange or it's not a public company, there is a dissonance even without investigation. We think that more could be done in terms of in terms of advocacy, awareness creation. More could be done in terms of engagement. So I will do more road shows. I will do more investor meetings. I will bring the clients the issuer into contact with this asset managers, and allow them ask questions. We believe that that is one way to deepen the market, and that is the way we work. And in the last few, we think we've begun to see traction. Thank you.
To develop this market now. Yemi, clearly you've come on board at FMDQ to try and bring that whole private equity experience and exposure and understanding what investors want to the table and hopefully organize this private market for us. So maybe you can speak to how things are evolving. And you've heard what Suru just mentioned in terms of that lack of contact between the issuer and the investors. How have you seen things change given the things that you have been doing over the last 1 year?
Well, thank you, Wale, again. And there is a growing awareness. It started out really, really slow. I would say, for example, when we started our own market engagement last year, talking to whether it's issuing houses and different groups of issuers, whether they're in manufacturing, real estate, we found out that a number of them had spent, so on the issuer community, there was excitement. The number of them have, they have applications waiting in banks. They try to raise money through other, private placements like Suru mentioned, without much luck. And a number of them, would give stories like, oh, I raised money from a bank outside of the country, and they asked me to provide some sort of local bank guarantees.
All right, thank you very much, Yemi, for that. Again, I want to encourage those who are online who have questions to please type them in so that we can take them as well. Okay, I think we have another question in the room. Please go ahead.
All right, good day, everybody. Yeah, so I have a question for Mr. Yemi. So majorly, I believe that what the investors want to do, we're talking about the institutional investors and everybody, is how safe are these platforms? So majorly the private markets, people have come to know about the public markets and they've gotten pretty okay with it. So I want to know how safe is the private markets and what things are you putting in place for these platforms to be, for the investors to feel safe and to be able to put their money in this market?
Okay, thanks for the question. I would say that the platform, like I mentioned, functions as an information repository. However, we do provide guidelines for issuers before they are noted. But a number of our guidelines, along with the guidelines that we provide, are supposed to ensure that the compact of the agreement between the investors and the issuer itself are sacrosanct. So, for example, if your investor decides that they want a credit report, we go through a checklist to make sure that you submitted a credit report. We're not the ones who say you must have a credit report. You don't have to have sort of guarantees, but the investor decides that this is the best way they would invest, and you agree with that, then we would ask you to sort of provide an extract of those guarantees. So, in other words, all the things that represent the basis for which the investor put its money in that security, FMDQ Private Markets will require you to provide us with that. We'll review it, and then that's also posted on the platform, so that the investor community, those who are invested in those securities, can track and see what's happening with their business. A year from now, if you are required to file your annual reports, or there's a change in key man risk or anything, or the trustees find out that funds were not used appropriately, the platform enables that trustee or the transaction sponsor, again, to report on what they have seen about that private security. And then the investor can see what's going on in the business that they invested in. That really is the framework that we have provided. And so you would see that it provides quite a little bit of what an exchange would also require for a company to come and get listed. But we've done it in a way that, again, that focuses on investors' needs. Because we do not act as a regulator, we're not imposing too many things for our own organization. We're thinking, what does the investor community need? What do the investors in a particular security, what are they asked for? And then we just ensure that those things are provided. We also have infractions and penalty guides in the marketplace. There's carrot and there's stick. And again, those things are
constructed to ensure that there's good behavior in the marketplace, that people are protected. But really, the biggest thing is that investors can track what's going on in their business. So that's the biggest value that we have.
The capital market is a confidence market, and you will not be able to attract the right type of or any type of capital if people have any reason to worry about the kind of information you are giving, the timing of the information you are giving to them, or they have reasons to second guess or doubt the veracity of your information or accuracy of them, of those things. Now, one of the things that a platform like the FMDQ Noting Information Repository does is that any investor has a right of question, has a right to know, and the sponsors are held to account to make sure they provide every promise that has been made to investors. So you are going to see a situation where somebody issues an instrument and 6 months down the line, 4 months or 5 months into that time period, the FMDQ is already asking the sponsor. So you know that you're supposed to bring in the half-year numbers. And you bring it in an expected format. Now, the sponsor also knows that its own credibility is affected by whether it complies with that or fails to comply with it. And because of those kind of engagements, more or less something like holding the feet of the sponsor to the fire, there is accountability. That accountability builds confidence. And you are not going to, even in public exchanges, that is essentially what is required. Okay, so the public exchange does not say that the management will always run the company properly, but it says that everything that is going on in the business, they have a responsibility to report it. And that is the same thing that is going on here. And we think that it's actually good for the private market because now investors are no longer orphaned. When they put their money, they don't know what is going on. That is no longer the case.
This is not the regular listed markets. Can I expect information to be given? How accountable are the issuers and so forth? But from what I'm hearing today, and which is something I think, especially the institutional investors who are joining us today need to note, is that even though it's not your typical capital market or stock market, the way it's organized is in a way to bring the same level of accountability and transparency that you will anticipate in those regular markets. So thank you so much for making those points. Now, we have a couple of questions that have come through, and if I can appeal to our speakers to try and be relatively brief so we can take as many of them as possible. The first one is about Greenfield project, which I think is a very important one. I wonder if we'll go back to Suru on this. But the question is, are Greenfield projects viable for capital raised in the private markets? Short answer to that, if you can.
Is, since the person has used viable, yes. The long answer is the structure determines what investors are comfortable with. Because if I bring a greenfield project that does not show investors clarity on offtake, how will the money come back? What will you sell? Who will be buying? How do we get paid? Are we sure that you will be able to sell at a price that you can then leave profit for us to get dividends or returns at the end of the day? So those are the real questions. It's the strength of the business, the business case.
Sure.
And in the issue of presentation, you can.
Well, I'm assuming the presentation is making that business case.
That's correct. Okay. That's correct.
Awesome.
So yes, greenfields are not out, but
right.
They are only in to the extent that they work for investors.
Sure. And I think to a related point, and I wanted to get your thoughts on this, Yemi, and maybe anyone else maybe Magnus can also chime in here. on the issue of credit enhancements.
Oh, yes.
Particularly for those who are in the infrastructure space. Obviously, we know that they prefer long-term capital for many of their projects, and they can potentially go to the banks there, but potentially the private markets is a much better and friendlier, and maybe I wouldn't argue more affordable place to go for that. But very often you will need credit enhancements, and I wanted to hear from you about the options that are available right now for potential issuers.
Maybe you want me to take that, Yemi? Okay. Okay. So I'll start by saying that credit enhancements take different forms and shapes and forms. We've seen guarantees coming in from international lenders or multilateral institutions. We've also seen credit enhancements from local banks. Yes. We have seen
for debt issues.
For debt issues, right. We have seen credit enhancements coming in from infrastructure-related entities like InfraCredit and all. Now, we have also seen insurance bonds playing a role in that space. So there are, to the extent that whoever is giving the guarantee has the right rating and capacity. And that capacity will be judged and tested before it is even projected. There is no limit to the extent of enhancements that could be provided. The only limit is in capacity of the enhancer.
Right, and this I think will be very important for the issuers. What is the typical impact of those enhancements in terms of the cost of capital? I don't know if you can speak to that point.
So yes, we currently have an infrastructure-related entity has a 200 billion naira program on FMDQ private markets that is going to soon start issuing series under that. And so those credit enhancements will effectively lower the cost of capital for the issuers. And there are
percentage points. If you, I guess it's a tough question, but maybe you can speak to that, because I'm trying to encourage the issuers to also look for this credit enhancements.
Well, we'll have to see until they actually hit the markets. We won't know, but I really can't speak to that.
Okay, so I can step in on that if you don't mind. I was having a conversation just over this weekend with one of the credit enhancement organizations, and I said to them that, look, you are a dissonance factor. Your pricing is a dissonance factor for issuers. And they said, no, so we've since reviewed that downwards, because we have come to see that the more volume that people are able to do on the back of our guarantees, the better for everybody. And that way, we are able to impact the market more than we are able to do prior to now. So in terms of percentage points and all of that, they come off with a flat fee, which you then over time, then they now charge an annual fee. So at a 1.5% costing, and I think that is trending lower and going down, because even in that space there is competition. So you are going to see that will keep going down as we go on. But that's what we think. Yes.
Two thoughts around this. I think the person who asked the credit enhancement question has a deep thought around it. And given the fact that typically the cost of raising capital through the private market tends to be relatively higher in some sense, if you bring the credit enhancement, it reduces the risk premium.
So, and as a bank, we are not likely to see that a debt is trying to go bad and then we bring it to the public. Okay, so the advantage we have is that we are also a bank, and that helps us in screening and reviews. But having said that, I think it will be bad faith for any sponsor to deliberately mislead the investing community by a less than stellar paper to the market.
We'll see. Yes, okay, Magnus, go ahead, please.
I think I'll just take a different view, which is clearly to say that when you're talking of raising funds, whether debt or equity, it could be for an early starter. It could be for a takeover or a buyout. It could be for a business that is struggling. So what I hear this person question is, this is a company that is not doing so well. The rating is not as strong as. The key thing there is this, making that information available to potential investors. And for the company, what it means that there'll be risk premium, because there has to be a risk-adjusted pricing.
Right.
So for the investor, you know that this is the situation with this issuer, and that is how we are going to price it. So you have to price it given the risk you are seeing. But the most important thing is that you must have all the information available, and those information must represent a true and fair position of the company.
Fair point. You wanted to add to that?
Yes.
Sure.
So there's something in finance that says, essentially, there's theory in finance about appetite for different kinds of companies. So it used to be that people would say in the West that, oh, if you don't pay dividends, you won't get investments, right? Or if you're a technology company who doesn't pay dividends and you start paying dividends, people would think that your high growth period is over and then you lose. No, the theory says, no, there are people in the marketplace, asset managers, who want companies who don't pay dividends. Another section of the market says, I want to invest in high growth companies who do not pay dividends, but taking all their dividends and use it for their growth. There are companies today who want credit A-rated paper, right? So they have an appetite for that. And there are companies that would say there's a company in the growth in the growth board of FMDQ. It doesn't have a credit rating, but I know the company has uptake. I like the sector it's in. It has certain things that give me some confidence, and I want to invest in it, right? I don't see any situation where, you mentioned borderline weak credit. If a PFA sees a borderline weak credit and its guideline says this, if it doesn't fit, then it should skip and not invest in that paper. They should then look for the highest grade instrument that meets their own investment needs. But there are other people in the marketplace that would desire that. And then second thing I want to note is that I think Sue made that point maybe, and I want you to take note of it. Unlike the perception that issuing houses in other markets, they do an issue and then they walk away. When a 5-year bond, when Coronation works as a transaction sponsor on a 5-year bond noted on the FMDQ private market every year for 5 years until it's gone, Sue stays with that transaction. So it's not a pump and dump kind of mentality. You stay. The trustees continue their work. The solicitors, all the people who are registered members of FMDQ's private markets has a role to play over the life of that instrument. And that, I think, is one of the unique things we have created to avoid this sort of dissonance that he's talking about.
That's really good to go. Very important for audience to appreciate the fact that you are not left on your own. The FMDQ as a platform is invested. The sponsor is invested in the transaction to make sure it works. So as much as possible, be guided by that. And hopefully that gives you some level of comfort. Well, I want to apologize to our virtual audience because I understand that we were disconnected for quite a while. So our sincere apologies for that, but I'm assured that there is a recording of this, and at some point I will be telling you how you can get an email to where you can select you can actually get a recording. So whatever you have missed, you still have an opportunity to view again. As I begin to round up, just another question here. It has been observed that investors rather invest in private bonds that has a credit guarantee or enhancement. So again, that issue is coming up. How well are the issuing houses and financial advisors trying to change this investment attitude within the buy-side space? I suspect this may be an issuer as well. Sorry, another sponsor, maybe. But your thoughts on that point? Is it just the reality of our environment, or do you think this is something that can change
so there is something to be said, and I've said that again, and I don't think we can say it enough, for confidence building. Now, when a market is in its nascent stage, people want as much comfort as possible. Now, as that market grows and diversifies, Magnus spoke to it, Yemi corroborated it. The market, first, the investing public is more knowledgeable and is more risk aware, such that it can determine what its risk appetites are and what it wants to take. And as that begins, as that growth happens, you begin to see that people are willing to do without certain crutches, for want of a better expression. Now, I don't know enough of a company because it's a private company. I say, okay, can I have somebody I know guarantee that company? The next time that company comes to issue, let's say it had issued a 5-year paper and has done splendidly well, you would look less for a guarantee the next time it's issued. Okay, so I think that the conversations around credit enhancement today are largely informed are coming largely from the place of seeking comfort. And the moment that comfort and confidence is gained, you will see that those things will not necessarily fall off, but emphasis on them will reduce.
Very good, important point. Thank you so much for that. And I think that we have tackled most of these questions, and our time is fast spent. So I want to begin to wrap things up now. First of all, by saying thank you so much to our panelists. Chinwe, my apologies that many of the questions didn't come to you, right? So, but it's understandable. Many people want to hear from Yemi and Suru about these transactions, and I think it's a positive. It really does show that the audience is interested in this topic. So once again, I want to say a big thank you to our panelists, and if the audience in the room can help us give them a round of applause, thank you so much. As we move on now, as we begin to wrap things up, I want to invite Tomi Ajayi, who is from Coronation Merchant Bank, to deliver a vote of thanks. She has some announcements to make as well. If you do go to the Q&A field, there is a survey that has been tagged in there, which we would like you to complete. Now, the carrot here is that once you complete the survey, you will get a link for you to get a recording of everything. So for anything that you have missed, you have an opportunity to view it all over again. So please, if you can just take a moment to take a look at the Q&A field and find that link for the survey, complete the survey, and you certainly will get a link to the recording. So on that note, I'd like to now invite Tomi Ajayi to deliver a vote of thanks.
So it's been a very informative session, and the time has come now to say thank you. We're grateful to God for insightful deliberations and for a successful event. We'd also like to appreciate everyone who has contributed to or participated in this event in one way or the other. We'd like to specially acknowledge our distinguished guest speaker, the CEO of the FMDQ Group, Mr. Bola Onodelikoko, for his continuous support and immense contributions to the development of the Nigerian capital markets, as well as his able representative, Mr. Akinyemi Oshinobi, again of the FMDQ Group. Thank you, sir. You've so brilliantly delivered a lot of insight on this topic we've discussed here today, alongside our moderator, Wally. Thank you, Wally, and our expert panelists who have brought their industry expertise and technical know-how to bear. Thank you to Chinwe and Magnus. To our regulators, very well represented in our audience here today. Your roles in guiding operators may appear painful sometimes, but without an iota of doubt, they're tremendously important and beneficial to the integrity of the capital markets in which we operate. So for this, we say thank you. Thank you to our investors who bring life to the markets. Your contributions cannot be overemphasized. To everyone representing public and private issuers or prospective issuers, you keep the markets vibrant and you keep investment bankers busy. So I'd like to personally say thank you to you. To capital market operators and to everyone else in this incredible audience we've had today, your participation is deeply appreciated. And finally, but by no means the least, to everyone over at Coronation Merchant Bank who's shown incredible passion, shared dedication, and for all the hard work you've put into organizing this event. I'd like to say thank you and well done. Wale has mentioned that you should please take the survey in the comment section, in the chat section, and you'll be getting a link to the video, to the recording of the session today. We'll appreciate if you kindly do that. We'll also, at this point, like to mention that the series 19 and 20 of Coronation Merchant Bank's commercial paper is on offer currently, and we'll be closing on Wednesday. If you're interested in learning more about this, please don't hesitate to reach out through the contact details that have been provided or will be provided shortly. Until the next edition in this series, we'd like to say we'll be greatly honored to have you all attend that as well. But until then, it's thank you so much and goodbye.
Ladies and gentlemen, we have now come to the end of the Coronation Interactive session. We trust that it was an insightful and rewarding experience for you. To get the recording of this event sent to you, kindly take the survey posted in the comment section. For further inquiries about Coronation products and services, please call Coronation Resolution Center, our interactive call center service, on 01-279-7640. You can also send an email to crc@coronationmb.com. Thank you once again, and see you at the next edition of the Coronation Interactive session.